some of the pretty public failures that are happening right now. It's all over the news. I know people have been asking me about it. We didn't, I mean, had no knowledge of this person. I didn't even know who this person was, but there's this kind of consortium or one person who had a bunch of joint ventures. There was hundreds and hundreds and hundreds of properties involved. $144 million, I think, is the total number, and of real estate. And that person, with the increasing interest rates, cannot sustain that, Patrick. And we got some bankruptcies that are taking place. And I think this is one of the many dominoes that will fall. And we'll talk about why not more have fallen, but this one definitely fell in the last couple of weeks. This has been all over mainstream media.
What? Wow. Ooh. Oh.
We talk about it a lot, and it wasn't one person. I think there was four, and then, of course, a whole lot of people involved in this whole thing. You know, the game that they were playing, and listen, it works. This goes back to what we've said many times. It's all good, you know, until the music stops, and this is what happened. So they were growing this portfolio. They're being very aggressive in terms of their strategy overall. It was good. It's not that they were doing anything out of line. They were doing lots of burrs. They were doing lots of buy low, renovate, refinance, all of those things. But here was the game that they got caught. They were doing a lot of private money to do those initial burrs. So in other words, they were borrowing money, buying the house, renovating it, then getting financing. Well, guess what? Rates went up at a record pace. They get caught going, oh my gosh, if I have to refinance, number one, can I? Number two, I can't refinance and make the math work anymore, and we can't get rid of these properties. Long story short, a lot of private money of that 144 million, a lot of it was private money, and we got caught when the music stopped because rates rose so quickly and as much as they did, and that just crushed that particular model. So in other words, it goes back to private money getting risk level interest rates, so higher rates, and they got caught.
All right, folks, here's what we're going to do. For everybody who likes and subscribe this week, Patrick is going to do 5 push-ups for everyone who likes and subscribe. So let's jack it up. And then, Patrick, I want you to post on YouTube all the push-ups you have to do.
Okay, done. I'll even put it on Instagram because I'm into the physical challenges these days.
Like, subscribe.
Comment.
Yeah. In this case, Patrick, you know, it's not so much because I know investors that are watching this they should be asking themselves a couple of questions, which is number one, how do I make sure this doesn't happen to me as an investor? How do I make sure I don't, bet the farm, so to speak? And it's not, and I don't even know this person. I don't know their portfolio. I have no idea. But what I will say just in general, and this has nothing to do with these individuals, is it's not private money that's the challenge, Patrick. What it typically is typically it's the LTV, the loan to value on the real estate assets. And a lot of private money will go up to 100%, if not beyond 100%. And if I'm not mistaken, that's what's happened here is they went up to and beyond full leverage. When there's no equity in a portfolio, then there's really there's no portfolio. This is just debt here at this point. And I think that's for the real estate investor that's watching this is how do I make sure that I never get caught in that particular and put myself in that position? The answer is keep your LTV lower. Do not ever, leverage up your portfolio where you're betting the whole farm up to 100% and beyond 100%, because then you don't have any real estate assets. All you have is debt. And that's a really dangerous game to play, Patrick. And these people got caught in it. And that's what happens. It's, by the way, this is not the first time it's happened. It happens all too often. And this is the kind of thing that's going to happen as this market continues to roll through. And the reason it happened to this particular group and not others is because there's a lot of people, Patrick, that, first of all, if you're doing financing with if you have an investor-focused mortgage broker and you're using more traditional channels, you typically can't go to 100% LTV, right, Patrick? You can go to 80, you can go to 75, you can go to maybe 85, but there's going to be some equity in that portfolio, and that's your buffer, that's your safety zone. And I think a lot of real estate investors, Patrick, they look at it and they don't think of it this way. They don't think of it as a safety zone, a margin of safety for themselves. They look at it as how little money can I put into this and how much real estate can I do? But if you are at the end of the day only saddled up with debt and you don't have any equity in the portfolio, you have nothing. You're playing a game that you're going to end up losing, and that's what's happened here.
Well, the risks got really high. We go back to, and let's get really clear on a couple of things. Aside from the fact that when you're in a boom cycle, everybody is a real estate genius. And so you're chasing yield because you see the opportunity. So investors are going,
I can get 12%, 14%, whatever the numbers are, 8%.
Depending on what that particular private lending deal is. But here's the point, JG, if we go back to, I don't remember the exact month, but in 2021, I want to say early in the third quarter, we were looking and going, first off, we didn't expect interest rates to go up as high and as fast as they did. But back in 2021, we were seeing the makings of all this starting to unfold, and nobody saw or could make that call about what interest rates are doing. And I don't even think the Bank of Canada was forewarning. I mean, gosh, they looked into the camera in 2020 and saying,
rates aren't going up. We're not even thinking about raising rates, blah, blah, blah.
We all know that story. But here's the thing. Back in 2021, within the RAIN community with our members, we were very, very clear. And I specifically said many times, things are going to get soft. This is not the time to be over leveraged. As a matter of fact, make sure you have liquidity because things are going to shift and change. And this is a way to hedge your bet. Liquidity, don't over leverage. I mean, those were really strong messages that we were sending back there. What's the message about that? Number one, we were right. Number two is that you have to look at the data and you have to look into the future of what's happening. And that's the game that we're trying to play all the time. Whereas in this case, it was being driven by emotion, being driven by greed, and nobody was looking at the data. They thought this run would last forever. We could go forever. And we've seen these cycles before. And this is a classic example of the music stopped and there was a whole bunch of chairs missing.
I'm curious to see, Patrick, and I was having conversations with other colleagues in the business this week, and there's a lot of people curious to see what's going to happen with this. I mean, it's a pretty substantial failure. $144 million around a couple individuals is a lot of real estate. This was not a REIT. This was not a fund. And by the way, there's a lot of people, Patrick, that are creating REITs and funds and mutual fund trusts around real estate in order to bail themselves out of these situations. So there's a lot of that anecdotally happening. I hear it. But what's interesting is I'm curious to see if there's going to be a regulation impact here. I mean, we sure as hell do not need more red tape in this business. But these, unfortunately, kind of failures attract red tape. They attract scrutiny. They attract audits. And I'm curious to see where it's going to go.
Where it's going to go is it's going to get far messier before it gets better. And that's the fundamental. There was another developer in Vancouver today, filed for bankruptcy, $95 million. There was one a couple of weeks ago, $165 million. So there's some big numbers that are starting to happen as these things come to, a conclusion based on what's happening in interest rates. But I want to just shine a light on something, which is when we go to our next segment, when we're talking about GDP, we have to consider the lag effect.
If you like what you learned here, go to the description below and subscribe for our free Insiders newsletter, where you can also stay up to date for our upcoming events and our courses.
If you want to see more stuff like this, click here. If you want to see the entire show, click there.